Welcome to Get Rich Education. I'm your host, Keith Weinhold. Could the 30-year loan, the most popular mortgage loan type in the United States, become extinct? And what exactly does it take for you to qualify for a rental property loan in today's lending landscape? Today on Get Rich Education. The company that's provided our listeners with more loans than anyone is Ridge Lending Group, NMLS 42056. You can finance more than 10 single families up to fourplexes. Serving most U.S. states, their knowledge and experience leads to your financial freedom. They're number one in the investment space. Pre-qualify and then chat with President Caeli Ridge personally. Start on your next investment property loan right now at ridgelendinggroup.com. Finally, Total Control Financial gives you checkbook control of your 401k and IRA money to invest in real estate. It's time to get your retirement money into your own checking account, but you've got to avoid the little-known tax that you'll pay with any self-directed IRA. Instead, it's time for the QRP. Learn more and get your free copy of the QRP book by text messaging QRP in all capital letters to 72,000.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Here it is. Hey, welcome to Get Rich Education. I'm your host, Keith Weinhold, bringing you that weekly dose of abundance. And I've got to provide you that because the scarcity mentality is abundant and the abundance mentality is scarce. The scarcity mindset says be debt free and we won't even listen to anything else. And the abundance mindset says get smart about debt and be financially free instead, because that's real freedom. In fact, get more debt to create cash flow for yourself. Be that sophisticated arbitrageur. That might sound sophisticated, but it really isn't. You're just borrowing at a lower rate and investing at a higher rate. Because when your debt is 100% outsourced to a tenant like it is in a cash flowing rental, now you've got residual income generation, and that is that base ingredient for your financial freedom. When we talk about how to mitigate the risk and optimize the profit on such an arrangement here all of the time. Today, mortgage interest rates are about 1.25% lower than they were just 12 months ago, and that's on both 30-year and 15-year fixed loan types. Today, we'll talk about what it takes for you to qualify for a loan shortly with a great guest, and what are the chances that the 30-year loan just completely disappears. Next week, Grant Cardone and I will be here on the show together helping you build your wealth. Yes, Uncle G on GRE, as we'll be getting some Cardone zone influence here. Today, credit scores are higher, and the reason that FICO scores are higher than they have been in years past has been aided by the economy, yes, but there are actually two more reasons for higher scores that have nothing to do with jobs or the economy. Now, 10 years ago, the average credit score was 686. Last year, it was up to 704. Today, it's up to 706. That's a 20-point improvement in just 10 years. Now, a strong economy has led to lower credit delinquency rates, but the rise has also been attributed to a higher consumer awareness of credit scores. And there are also reporting standards that have changed because they've removed some negative information. Well, when we talk about the potential privatization of institutions like Fannie Mae and Freddie Mac, let's break down what that really means. Let's talk terminology. We're called Get Rich Education, so let's explain what's meant when you hear the term secondary mortgage market so that you aren't left behind. Say that a consumer like you wants to get a loan. So you go to a local bank. Local banks want to grant lots of loans to people like you, but they have a limited amount of money to lend out. So what they do after they make a loan to you is that they sell their loans on the secondary market to a place like Fannie Mae. Fannie Mae now owns a bunch of loans from different small banks like this. They package these loans, and then they name that package an MBS, a mortgage-backed security, so that they can sell that security to an investment bank or hedge fund. And these might include companies that you've heard of, like Citigroup or JP Morgan. And then finally, investors can then buy shares in this MBS. So that's the explanation about what happens to the loan that you originate at your local bank. The primary mortgage market is that transaction between you and your local bank, and it's called primary simply because it occurs first. The secondary mortgage market, that's what happens after your local bank sells your loan to a big institution like Fannie Mae. It's called secondary because it happens second. So, said another way, newly originated mortgages, the local bank being the originator, are sold by that originator into the secondary market, where they are packaged into these MBSs and sold to investors in pension funds, insurance companies, and hedge funds. So to summarize and be clear, the primary mortgage market is where a loan is created. The secondary mortgage market is where a loan is sold. A loan must be created. That activity is primary and it happens first. Then a loan is sold. That activity is secondary because it happens second. Well, with that understanding, let's play this piece. It's about 4 minutes long. It tells you more about the potential privatization of these loan backers and packagers known as Fannie Mae and Freddie Mac. And there's a lot of information here. You may want to skip back and replay a piece or two. Then I'll come back with some more context and commentary.
Owning a home has long been a staple of the American dream. And at the center of that are two big companies, Fannie Mae and Freddie Mac. Sound familiar? Maybe you haven't thought that much about them since the 2008 financial crisis.
The federal government is stepping into it to stabilize Fannie Mae and Freddie Mac.
The two companies almost collapsed under the weight of an unprecedented housing bust. But then the government stepped in to bail them out. Now, the Trump administration has asked for plans to reshape Fannie and Freddie. But a housing finance overhaul could mean privatizing or shrinking the two companies. A process that some believe could mean mortgages will become more expensive and less affordable for millions of Americans. That includes the most popular home loan in the U.S., the 30-year fixed-rate mortgage. Homeowners like this mortgage because of the low monthly payments and the interest rate that doesn't fluctuate. We'll explain, but first you have to understand how Fannie and Freddie fit into the U.S. housing system. First, homeowners borrow money from banks or other lenders. Then, Fannie and Freddie buy these mortgages and package them into securities. Then they sell those securities to investors. Investors buy them because they're considered safe, because Fannie and Freddie take on much of the risk. Lenders and banks benefit too. Since the government takes on much of the default risk, lenders can make more loans to more people. Together, Fannie and Freddie now back about half of new U.S. mortgages. So, why do some want to change the two companies? Some in Washington want to shrink or even get rid of Fannie and Freddie. And President Trump himself has indicated that he wants to roll back the government's involvement in the two companies, which have been under government control since the financial crisis. But a housing finance overhaul could mean privatizing or shrinking the two companies. Those looking to shrink Fannie and Freddie argue that the government shouldn't be involved in the housing market to the extent it is now. They say that the private sector, not the government, should be filling this role. But those who support Fannie and Freddie say that homeownership is a path to prosperity for the middle class, and that the government has a responsibility to keep housing affordable. But now some are wondering, what would the U.S. housing market look like without Fannie and Freddie? Well, to start with, many non-bank lenders might find it harder to operate. Unlike banks, these firms don't have deposits, which means it will be more expensive for them to lend money if Fannie and Freddie go away. These so-called non-bank lenders make up about half of new U.S. mortgages today, and they're often the only path that first-time borrowers or middle-income families have for getting a mortgage. That's because in the last decade, many banks have focused largely on wealthy borrowers when making mortgages, and the non-banks have moved in to fill the space they left. Beyond that, no one's really sure what the market would look like without Fannie and Freddie. But let's consider other countries, which don't operate their housing markets like the US does. In many countries, long-term fixed-rate home loans, including the 30-year fixed-rate mortgage, aren't largely available. Instead, mortgage rates reset depending on the market. And even a 1-point increase in your mortgage's interest rate can add hundreds of dollars to your monthly payment. We can also look at the US before Fannie was created in 1938. Back then, borrowers had to come up with much larger down payments, often 50% or more. Mortgages also tended to last for just 5 or 10 years, with a big balloon payment that came due at the end. So, future mortgages could look like this, or not at all. Much of it depends on how the government plans to reshape Fannie and Freddie. But reshaping them won't be easy. People like the benefits they create, including the 30-year fixed-rate mortgage. And right now, there isn't much agreement on either side of the aisle on how to get rid of the government's involvement in housing, at least not without completely overhauling the way the housing system works. So, for now, Fannie and Freddie's future is still up in the air.
That material is courtesy of the Wall Street Journal. Privatization should mean more competition, and that is generally good, but there may be some pain in getting there. Keep in mind that what this means to you if mortgages are less accessible for people is that it could make it harder for you to make new purchases. That's the bad news. The good news is that if it's harder for other people then to qualify for mortgages, well, the demand for renting property from you, if you already own property, will increase, that greater rental demand. Today's guest and I will discuss this and then what you need to do to qualify for income property loans yourself today. And in understanding what it takes for you to qualify for an income property loan today, the DTI, the debt to income ratio, being the total of all your monthly minimum debt payments divided by your gross monthly income. That means, for example, that if your total monthly minimum debt payments are $4,000 and your gross monthly income is $10,000, then your DTI is there for 40. What does that DTI include and what doesn't it include? Today's guest will tell you about this and so much more. Today's guest is the president of Ridge Lending Group, and she has spent the last 20 years as a nationwide lender and loan officer. Importantly, she's a real estate investor herself, so she really understands what you need. Her firm specializes in income property loans, and they work with tens of thousands of investors and homeowners just like you all over the nation and outside the U.S. If you've been listening here for any amount of time, you already understand that she has helped more people realize their dreams of financial freedom through real estate than any other mortgage lender in the United States. Most mortgage lenders don't even talk about something like financial freedom. Her company has also helped more GRE followers, yes, you, acquire income property more so than any other lender in the nation. It's a real honor to welcome back onto Get Rich Education, donating her time to you once again. Here is Caeli Ridge.
Keith Weinhold, my friend, I'm so happy to be here as always. Thank you for continuing to have us as I hope, a mainstay for your listeners' education.
You've been so good about helping everyone out, and we always talk about the importance of leverage here, and you are a pathway to that. One particular place where leverage in the loan climate could potentially change, we haven't talked about it too much on the show, is the potential of Fannie Mae, Freddie Mac privatization. Fannie Mae and Freddie Mac have been under government control since the global financial crisis. Tell us more about really what Fannie Mae and Freddie Mac privatization is, in your words.
The dissolution of the GSE, government-sponsored entity, is a realistic occurrence. I mean, I think that this is something that is more likely to happen than not. And in just kind of basic terms, everybody, what that's really going to mean is removal of the 30-year fixed. That's the bottom line of what that would equate to.
That would be giant.
Yeah. I have some thoughts on that, but let me kind of just describe why that would be the case. If we remove the government part of mortgage-backed securities, right, and the guarantee that the United States of America puts on these mortgage-backed securities via Fannie, Freddie, it probably is no shock to the listeners that the secondary investors are not going to be offering 30-year fixed money without USA guarantee at 3 and 4%. It's just not going to happen. So the adjustable rate mortgages will become more prevalent. I mean, that's not to say 30-year fix is going to be gone. It'll be out there. But what has been an inverted yield, meaning that an adjustable rate mortgage is in many cases pricing a higher interest rate than a 30-year fixed, is going to go back to normal. An adjustable rate mortgage is going to be a point to 2 points lower than the 30-year fixed money if Fannie and Freddie go away.
So we're talking about potentially having no government safety net backing up that loan. Therefore, the lending institutions would probably need to charge a higher interest rate because they need to add what we might call a higher interest rate premium in order to compensate for some of that risk.
Exactly right. Perfectly said.
Any other thoughts with how privatization would change things if they aren't government guaranteed any longer?
Right now, in our current playing field, what we're talking about in our industry is called non-QM. This gets a little technical. QM stands for qualified mortgage. Everything Fannie and Freddie is defined as a qualified mortgage. This qualified mortgage comes with very defined definitions about what is ability to repay. The non-QM is now going to be kind of the normal. And my feeling is that if this happens, if the deregulation of the GSEs actually does happen, non-QM or just secondary investors, secondary market loans will become, I hope and believe even, more competitive. I think that to open that up in some ways is going to create enough of a playing field that you're going to have so many alternate options to what is Fannie Freddie today that they will start feeding off of each other as a way to kind of describe it. There will be a lot more competition. So I'm hoping that the products and even the interest rates will see some significant improvements as well.
I don't think anyone really understands what will happen if Fannie and Freddie become privatized.
I would agree with that statement, Keith. I think that anybody to try and predict would be short-sighted. I'm not sure that I would even put my 2 cents out there on the line this early. I'll reserve any formal opinion about it. I do think there's going to be some good elements to it, and certainly there's going to be some challenges to it.
It seems unlikely that the government allows the disincentivization of homeownership to any great degree. Oftentimes, they've jumped in whenever homeownerships needed to be bailed out, much like they did during the global financial crisis 10, 12 years ago.
True. FDR is what started Fannie Freddie to begin with, well, Fannie anyway. And then again, I think, 1990, when George W. incentivized looser guidelines so that less advantaged individuals could take advantage of home ownership. That's going to significantly change, I believe, going forward. I think that the qualification, at least once we see this QM patch, is what it's called, where the debt to income ratio threshold today is going to be tightened up. I think that that's going to make it more difficult for qualification in the big picture. We're going to have to wait and see. It largely is going to depend on the election. And I don't know how much we want to get into that, but it is a foregone conclusion. If Trump gets reelected, the desecuritization of the government-sponsored entities will go away. And it's no secret. Republicans have wanted to open this back up to Wall Street and secondary investors since the crash. I mean, they wouldn't have put it this way to begin with anyway.
Well, as far as what's happening in the here and now, you specialize in income property loans, not primary residence loans, on 1 to 4 unit properties, rental single-family homes, duplexes, triplexes, and fourplexes. Let's talk about where must one's down payment come from in the lending environment that we're in today.
So for an investment property, residential, as you described, single family up to 4 unit, the down payment must be what we call liquid, right? Checking, savings, money market accounts, tapped in equity from a property. And those funds must be sourced and seasoned. Sourced and seasoned is defined as over the last 60 days or 2 months worth of bank statements that were supplied. Large deposit will be defined as anything over 50% the individual's income. We can prove that that large deposit originated with the individual. Let's just say that there's a large deposit of $50,000. Great Aunt Alice said, go invest in real estate. That's fantastic. But that $50,000 would not be considered sourced and seasoned until it sat in the individual's account for that full 60 days of bank statement cycle. So if it went in today, the 15th of October, let's say, and the banking cycle for that individual was the 1st through the 30th, I would not allow that $50,000 for the October statement. November and December, however, would then be deemed sourced and seasoned liquid funds.
Don't we all wish we had a great Aunt Alice? So let's talk about what we call the golden ticket, those first 10 loans for income properties or single, or first 20 for married couples. Let's just quickly review those before we go on. The down payment amount, the debt to income ratio, and the FICO score, just to be sure that nothing has changed with the golden ticket qualification.
This is defined as it states or sits today. Obviously, with some of the changes that are going to be coming early in 2021, there'll be some revision to this. But as it is today, we'll start with single-family residence in the loan-to-value allowance. On a purchase, you can actually leverage to 85% on a single-family residence. For a 2 to 4 unit, it's going to be 75% or 25% down necessary. Refinances come with some more restriction on loan to value. Cash out refi is going to be 75% for a single family residence or 70% for a 2 to 4 unit. Rate and term refinance, which simply means that you're replacing one loan for another loan for whatever reason is the tangible benefit, maybe a reduction in interest rate, maybe you're taking an adjustable to a fixed rate mortgage. The loan to value applicable on those single family residents can go to 85% on a rate and term refinance or 75% on a 2 to 4 unit. Now the qualifications as it relates to conventional, as you mentioned, I think there are 10 what we call golden tickets per qualified individual. So a husband and wife often will qualify independent of the other, opening it from 10 joint to 20 separated. There are 2 very distinct underwriting books in the Golden 10 per individual that we have to adhere to. The first book applies to 1 through 6 of the 10. And then there's a second book or new set of underwriting guidelines that will apply to the 7th, 8th, 9th, and 10th conventional loan spot. We'll talk about credit assets and debt to income ratio, and I'll go through each of those very quickly. Credit score in 1 through 6 book of underwriting guidelines is vague. There's no hard and fast. As low as 650 can get approved if they have compensating factors. That would be low debt to income ratio or strong assets. Once we get to the 7 through 10 for credit score qualification, the individual must maintain that 720 or greater credit score for any one of those loans. There are some optimization tricks that we can teach our clients. In fact, that education, as you know, and probably most of your listeners know, is really the primary value add that Ridge provides, kind of strategy stuff. Moving on, though, assets. So the asset requirement, we're going to just kind of talk about the reserve, which is required. The reserve can be in liquid or non-liquid form. Retirement accounts, your 401k, your self-directed IRA, your whole life insurance policy, all of these are applicable. The number of financed properties is going to determine what the percentage on the outstanding principal balance of rental mortgages will be calculated for. There's a matrix. I'm just going to very quickly, it's going to be a little bit more complicated, but I'll just outline. Loan spots 1 through 4 will require 2% of the outstanding principal balance on the rental properties only.
All right.
Plus 6 months PITI on the subject property. Properties 5 and 6 moves to 4% of the outstanding principal balance. And then 7 through 10, it becomes 6%. As a quick example, let's say the borrower is purchasing property number 10. And in our example, property number 1 was used for their primary residence. Now, while the primary residence counts as the number of financed properties, that unpaid principal balance will not be included in the calculation.
Only the income properties.
Only the income properties, exactly right. Debt to income ratio.
DTI, debt to income ratio. So the borrower's total monthly minimum debt payments in their life divided by their gross monthly income. That's what we're talking about here, the DTI, the debt to income ratio.
Correct. And it's a monthly factor. It's a monthly calculation. So the threshold is 50%, and that's today. 50% the income extracted from the documentation the individual supplies us, divided by the monthly liabilities found almost exclusively on the individual's credit report. Now, I say almost because there's 3 elements to that that will not be found on the credit report, but must be included in the DTI. They are rent. If you are not a homeowner, I need a primary housing expense. Second would be HOA dues, homeowners association dues. And then lastly, any taxes or insurance that are not included with the mortgage payment. Only the principal and interest. The taxes and insurance won't show on the credit report, so I must include those as well. Otherwise, everything else that goes into DTI will be on that credit report. The reason I make a point on that is that people often mistakenly assume that other ordinary monthly expenses play a role, like food or gas or utilities or cell phone bills, when in fact they do not. So yeah, 50% debt to income ratio is the threshold right now, and we'll see what happens in the coming months and year.
We're talking about reviewing the golden ticket loans, those first 10 properties for single or 20 properties for married, specifically for income property. So a lot of information there, a lot of numbers. To review one thing that you brought up, you talked about a minimum of a 15% down payment on an income property, single family home, or 25% down for 2 to 4 unit properties. For the single family income properties, it's a 15% down payment, but there would be PMI, or a 20% down payment with no PMI. Is that correct?
Exactly right. Yes. Now, I want to make a point on discussing that PMI piece. People hear that term and automatically, I think, just kind of reject it. I would encourage them to look at it side by side. The PMI factor is relatively low, and depending on the purchase price, or AKA the loan amount, that factor of, say, 0.52% times the loan amount divided by 12 months might only be $30 a month. But if it saves the individual 5% of capital, where they can stretch that dollar a little bit further, it may be worthwhile to consider.
15% down on an income property, single family home, rather than 20%. It means more leverage and less cash flow. I have a question, Caeli. If one were to put 20% of a down payment on that single family home, I know oftentimes they have the option of putting more than the minimum down, a 25% down payment on that income property, single family home. That gives them less leverage, more cash flow, and typically a lower mortgage interest rate. Can you tell us what the mortgage interest rate spread would be if one put 25% down on an income property, single family home versus 20%?
Sure. Now, there's a variety of variables that are going to play a role, but in general, you can expect maybe 3/8 of a percentage point less on 25% down versus 20% down. Now, I don't know if we'll agree on this point, Keith. I'm interested to hear your comments. I am a strong proponent of the leverage. The math is pretty simple, right? The difference in payment, via the lower loan amount, the lower interest rate versus the difference in retained capital, almost always the extra leverage is the way you want to go. If you divide the two, and I can give an example if you'd like, usually it's an 8 to 12 year recapture rate, meaning savings versus capital used. I think that's too long. I think that recapture is too long of a window for it to be financially viable.
I agree. I'm generally a leverage proponent. The question that I would have is, if one wants to get that 25% down rate, but only put a 20% down payment on the property, could they instead put a 20% down payment on the property, buy a discount point, and effectively put about 21% down and still get the rate they would get at 25% down?
That's an excellent question. More often than not, the secondary markets that are putting the long-term 30-year fixed rates out there, they're hedging bets, if that makes sense. You can kind of see on a day-to-day basis exactly where they want those rates. So in answer to your question, typically it's not going to be point for point, first of all. But generally speaking, the discount point beyond what is called a par rate also takes too long in the division, that math, for the recapture period of time. I would say it's usually 7, 8, 9 years. I think it really will depend on how long the individual plans to keep the property. To answer the question accurately, generally, no, it does not work that way. It would be too costly to get the rate down that low. And like I said, the recapture rate, I think, is a little too long.
One of the most substantial myths out there in income property investing is that after you've exhausted your first 10 loans for single or 20 for married, that the terms get sour, but that's not true. Caeli's going to tell us more about that when we come back. You're listening to Get Rich Education. I'm your host, Keith Weinhold.
Would you like to know the easiest way to create wealth and passive income with real estate? This is Marco Santarelli with Norada Real Estate Investments. Now you can access the best deals without the stress or hassle of having to find, renovate, or manage those properties. We save you time by providing you with passive income investment properties in some of the best U.S. markets. Learn more by downloading your free copy of The Ultimate Guide to Passive Real Estate Investing. There's no obligation and nothing to buy. Simply visit passiverealestateguide.com and get your free copy today. That's passiverealestateguide.com.
Countless property investors get killed with maintenance costs, but that's far less likely when you buy brand new construction. Let me tell you about JWB Real Estate Capital in Jacksonville, Florida. They pioneered the build-to-rent model where you can invest in new construction, turnkey rental properties. That's why JWB was featured on the front page of the Wall Street Journal. To learn more and see inventory, go to newconstructionturnkey.com.
This is Peak Prosperity's Chris Martinson. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
You're listening to the show that's created more financial freedom for busy people just like you than nearly any show in the world. This is Get Rich Education. We're talking with Ridge Lending Group President Caeli Ridge. Caeli, I think one of the more substantial myths out there is the terms just get awful and really bitter after you qualify for your first 10 or 20 properties. But that's not necessarily true with your non-QM product. Tell us about that.
Sure, you bet. So beyond the golden ticket 10, there are non-QM products that are almost in all ways identical to the Fannie Freddie loans. 30-year fixed, the same leverage, similar qualifications. The primary difference is rate. You're going to be looking at a point to a point and a half higher on the non-QM loans. Prepayment penalties might apply on those loans, but they tend to be 2 to 3 years. So for the buy and hold passive income investor, that tends not to be an issue.
Yeah, no one should be buying and holding for less than 2 to 3 years anyway.
Right.
Any balloons on those?
Not for the non-QM, no. If we're talking about commercial or cross-collateralization of residential property, then yeah, you can expect to have a 5 or 10-year balloon term.
Now, if someone wants to buy multiple properties in a short period of time, how does one transaction affect the other? Any considerations there?
Well, sure. It really depends on the baseline debt-to-income ratio that we start with. Generally speaking, rental income calculation in the acquisition year, which means before it hits a Schedule E, should be the individual's benefit. It should be to their advantage. So depending on sequencing, if we can make sure that each of these multiple acquisition properties have leases or will have leases in short order, chances are if they qualified for one, there should not be a problem with them qualifying for 3, 4, 5, 6 at one time.
I have a really interesting question. This is something that I asked you a year or two ago. You see so many appraisals come in there since you offer income property loans in 35 or 40 U.S. states, and you see such a substantial volume. So in today's climate, I'd be really interested to know of the appraisals that you see come in there, what percent of appraisals come below the contract sales price? What percent come in right on the contract sales price? And what percent of appraisals come in above the contract sale price, just roughly?
Yeah, so it's really going to be more subjective to the market itself. But I'll tell you, I've seen kind of a paradigm shift when, we were seeing more often, not the majority, but more often we were seeing lower values come in below the purchase price or estimated market value. I would say the below right now is probably less than 5%. On the money is probably the majority, but I am starting to see kind of that shift where we were seeing more that came in low. I kind of feel like that it's taken like a 180 and it's the values that are now coming in higher. So let me just be more specific. 5% or less where we see appraisals come in low anymore. I would say a solid 75, 80% right on the money. The remainder would be above the projected purchase price or ARV, after repair value.
That's interesting. So just approximately 5% of appraisals coming in below the contract sale price, 75 to 80 right on, and then the remainder, which might be 15% or so of appraisals coming in above the contract sale price. So therefore, more coming in above the sale price than appraisals that come in below the sale price.
Now, I would quantify that just by saying that when I say above, maybe it's $1,000, maybe it's $2,000. It's rarely going to be anything substantial.
Well, that's really interesting. Well, you do so many loans in there, and mortgage interest rates are substantially lower than they were a year ago. We're looking at 30-year fixed interest rates, more than 1% lower than they were 12 months ago at this time. What has that done to your refinance activity?
Huge. And this is a very busy time for us because we're so investor-centered. Year-end push for tax credits and stuff. I can't tell you, we've had just a huge influx of applications, and specifically for the refinances wanting to get in on these lower interest rates.
It's got to be so efficient. You can get cash out and increase your velocity of money and pay a lower cost of money as a lower interest rate all at the same time.
Yeah, we're seeing a huge amount of that desire. A lot of clients are coming back and saying, well, we just refinanced a year ago at 5.75. What can we get right now? It ends up being a real win-win.
Now, you offer a product called the All-in-One Loan. What it is basically a first lien product that operates much like a HELOC, and that offers a lot of flexibility to people. They might pay a higher interest rate than they would on a conventional amortizing loan, but still pay less in interest. And they'd have that flexibility of either making an interest-only payment or making an extra principal payment if they chose to do so. And we talked about that in depth when you were here earlier this year, that all-in-one loan product that operates like a first lien HELOC. So we don't have time to go into all of that today, but that is tied to the LIBOR, and the 1-month LIBOR is quite low now as well.
Yes, sir. As of October 1st, I haven't looked today, but we were posting at 2.01%. Some quick historical averages that might be helpful. The 1-month LIBOR's 25-year average is 2.71. The highest that it's ever been in 25 years was in 1989 at 10.08, I believe. So yeah, we've been hovering in the 2%. 6 months ago, 2.44. We're down to 2.01 today.
I don't want borrowers to get too excited. There is a margin you need to pay above that LIBOR, but yeah, that all-in-one loan product is effectively a first lien HELOC tied to LIBOR. That's something worth looking into and at least running a comparison to see if that saves you in paying interest or at least provides you with some more flexibility. Caeli, are there any common obstacles that you see in there that a borrower can eliminate now in order to qualify later? Maybe especially someone that thinks they're not quite ready to qualify now, but things that they can do to position themselves such that they are in qualification when they have their down payment or whatever else ready.
A couple just common things that we see throughout a loan transaction. Don't quit your job. I know it sounds funny, but it happens. I mean, people might quit their job thinking that they're going to become real estate investors and not realize that in order to do that, there's some planning, right? You've got to have a 2-year history of any kind of income to qualify for the best rates and terms. Vacation is another one that we see. Borrowers will go on vacation in the middle of a loan transaction, and that can derail certain timelines and close dates. And then I might also comment disclosure. Mr. Smith, let's say, purchased a property for cash, right? It's free and clear. Maybe he assumed that because there isn't a mortgage on it that it doesn't need to be disclosed, when in fact it absolutely does. There's still taxes and insurance that must be included in a debt-to-income ratio. So disclosure, not just on mortgages, but any new consumer debt that one might secure is very important to tell your lender about. Even before it happens would be ideal.
Don't quit your job, but it might be a good idea to qualify for as many loans as you practically can shortly before quitting your job, since that will change your landscape pretty substantially.
Yes.
Any last thing that a prospective borrower should know as we head toward 2020?
Sure. I would say that the most important thing for the individual investor, if they want to qualify in the 2020 year, would be not to file a federal tax return, especially if they've acquired rental property in 2019, not to file 2019's tax return until your lender, ideally Bridge, reviews the draft first. There are a lot of moving parts, especially on a Schedule E, which is where the rental properties will fall on a federal tax return, that if we have an opportunity to review in advance, we can provide the appropriate feedback or recommendation that will overall optimize the individual's qualifications going into the new year.
That is a great tip to consider for you, the listener's own planning. Well, Caeli, you there, Ridge, you can do loans in 35 or 40 U.S. states. The last time I checked. 43.
Yeah.
All right. You just keep expanding. And that includes pretty much all of the investor advantage Midwest and South, those states. So tell us how someone can learn more about getting started with Ridge in an income property centric.
I would love to. Several ways to reach out to us. Their website, www.ridgelendinggroup.com. They can call us toll free, 855 747-434-3855-74 Ridge as an easy way to remember. They can shoot us an email at info@ridgelendinggroup.com, and we are on standby at their service.
Caeli, you've been an asset to Get Rich Education followers here nearly since the beginning. Thanks so much for coming back onto the show.
Thanks, Keith.
Well, valuable and timely material from Caeli Ridge today, as always. Hey, I've got to thank you, the loyal listener, for coming out and meeting me in person at our Tampa, Florida real estate field trip that ended 1 week ago. We had casual meet and greet time on the first day. Then the second day was our speaker day, where I was the keynote speaker and the event MC. And then finally, on the final day, the income property tour, which was held just north of Tampa, St. Pete. And yes, that was my first time being an event MC. That's right. I was the guy that jumped up and cut off the other speakers when they started running on for too long. And then after doing that, I thanked them for coming. Thank you for showing up. The fact that so many of you flew across the country to come meet up was, well, really rather heartwarming for me. Some of you even telling me there face-to-face in Tampa that I've changed your life with this show, and that meant the world to me. It's hard to express how just a few words really did touch me like that. And of course, some of you didn't say exactly how I've changed your life. Maybe when you started listening to this show, you were wealthy, and now you're broke. At least I don't think that's what you meant. Hey, as I often say, coastal areas don't work very well for cash flow because desirability to live on the coasts pushes up prices higher, then rents can go up and nothing cash flows. Well, Florida is one of those few places where you still have some coastal markets, like Tampa, where the numbers still work. So that door might close on those opportunities in 5 years or 10 years because people find Florida as an increasingly desirable place to live. So it could be so desirable to live in Florida in the future that the numbers no longer work. And, well, that's just one reason that I had this sense of urgency to do the field trip in Tampa now. Next week, we're 10Xing here on the show as Grant Cardone and I will help you build your wealth together. Thanks to Caeli Ridge today. Check out Ridge Lending Group for qualifying for your next income property loan, or if you'd like to refinance your existing properties at these ultra low rates like we have today. Also, check out their all-in-one loan calculator to see if switching your conventional mortgage over to a first lien home equity line of credit product makes sense for you or not. That all starts at ridgelendinggroup.com. I'm your host, Keith Weinhold, and I'll be back next week to help you build your wealth. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.